The fable of the tortoise and the hare is one of the simplest stories ever told. On the surface, it's a children's tale about an overconfident hare and a slow, steady tortoise. The hare has all the speed, all the flash, all the raw talent to win by a mile. But somewhere along the way, he gets distracted. He burns energy too quickly, loses focus, and stalls out before the finishing line. The tortoise, meanwhile, just keeps moving, deliberate, consistent, never stopping, and eventually crosses the line first. Most people hear it as a moral about patience. In markets, it's far more than that. If you spend any serious amount of time trading or investing, you see the same story play out again and again. It stops being a fable and it starts looking like a natural law. And in finance, that law is merciless. The hares of the market are impossible to miss. They burst onto the scene in a flash, fast, loud, and spectacular. Their returns are so extreme, so impossibly good that it feels like they've discovered a hidden door in the market no one else knew existed. At first, it's intoxicating. They can do no wrong. Every trade works. Every chart they touch seems to go vertical. Their names ripple through trading forums, whispered like they're running a secret playbook. Headlines call them geniuses. Investors trip over themselves to give them capital. And then, inevitably, at the peak of their power, they just vanish. Not with a gentle fade into obscurity, but with a kind of catastrophic implosion that erases years of gains in only days. It's not a mystery. It's the math of speed without restraint. For example, in 2021, Bill Huang's Archegos capital management became the ultimate modern hare. Hang had pedigree, a career at Julian Robinson's Tiger Management, the launch of Tiger Asia, and then a low-profile pivot into running a private family office. On the surface, Archegos looked modest, but beneath that quiet exterior, it was a building a fortress of leverage. Using opaque derivatives called total return swaps, Archegos took enormous positions in a small number of stocks without triggering the disclosures that come with owning the shares outright. On paper, they managed about $10 billion. In reality, their market exposure was closer to $50 billion, 5 times larger, with the difference built entirely on borrowed money. For a time, it was perfect. Their positions climbed, the leverage multiplied the wins, and because the trades were hidden in swap agreements, the market and their competitors had no idea just how concentrated the bets were. Then came March 2021. A few key positions began to slip, not a crash, not a market-wide panic, just enough red on the screen to trigger margin calls. When you're running that much leverage, just enough is all it takes. The same prime brokers who had fueled the sprint, Credit Suisse, Nomura, and Morgan Stanley, suddenly turned into executioners, dumping shares to protect themselves. Billions in stock hit the markets in hours. Prices dropped, triggering more margin calls, forcing even more selling. Within 2 days, Archegos was a smoking crater. Huang's fortune disappeared. The banks lost over $10 billion. Their hare had hit the wall at full speed. 15 years earlier, the same script played out in commodities. Amaranth Advisors was the new star of the hedge fund world in 2006, managing around $9 billion. Its crown jewel was Brian Hunter, a trader whose bets on natural gas were as big as they were directional. Hunter didn't nibble, he swung from the fences with leverage, and when it worked, the profits were staggering. By mid-2006, Amaranth was dominating the energy markets. Hunter's trades became self-fulfilling forces, so large that they moved the market in his favor. Investors couldn't wire money fast enough, but there was a fatal flaw. The entire strategy leaned heavily in one direction. In September, natural gas prices turned sharply against them. Losses didn't bleed in slowly, they absolutely detonated. Over $6 billion vanished in a single month. Amaranth was forced to liquidate. In the span of weeks, the rising star was gone, leaving only another cautionary tale in a long list of hares that sprinted too far, too fast. And then came crypto, a market that practically breeds hares. In 2022, Do Kwong's Terra Luna ecosystem was the fastest hare the space had ever seen. The promise was unprecedented, an algorithmic stablecoin paying double-digit yields through its anchor protocol. It sounded like magic. Billions flowed in from retail traders and institutions alike, seduced by the idea of a system that could print stable returns in an unstable market. For a while, it worked. Yields kept coming, Luna's price soared. Do Kwon was hailed as a visionary, even a kind of crypto messiah. But the architecture was extremely fragile. It relied entirely on perpetual demand and unbreakable confidence. When confidence cracked, the mechanism unwound violently. Terra's peg to the dollar broke, Luna's price collapsed into freefall. In just 1 week, over $40 billion in value was gone. The hare had sprinted straight off a cliff. Now, these weren't freak accidents, they were the inevitable conclusion of the hare's race. Speed is both the hare's greatest strength and its greatest weakness. When every dollar is committed, when positions are maxed out, there is no cushion, no safety margin. The first serious turn in the market isn't a warning, it's a death sentence. The hare can't slow down, it doesn't have brakes, and when the wall comes, it comes hard. The tortoise now runs a different race entirely. The tortoise doesn't obsess over this quarter's ranking or today's leaderboard. The tortoise compounds, and in markets, compounding is not slow, it's unstoppable. In the beginning, the tortoise's equity curve is very unimpressive. It doesn't double in a month, it doesn't make the headlines, but it never resets to zero. And because compounding is exponential, the modest slope eventually overtakes the hare's vertical spike, and then it keeps going. The truth most traders miss is this: you don't need to chase blistering monthly returns to build life-changing wealth. The difference between, say, targeting 3 to 5% per month and 7 to 10% per month might sound small in theory. In practice, it's the difference between surviving for decades and getting completely wiped out. The trader chasing the bigger number inevitably runs thinner margins of safety, takes on more correlated risk, and exposes themselves to drawdowns they can't recover from. The trader who targets the smaller, steadier number can weather deeper shocks, keep reserves intact, and let compounding do the heavy lifting. Warren Buffett is the most famous tortoise alive. Over 6 decades, he's compounded Berkshire Hathaway's book value at around 20% annually. 20% doesn't impress the crypto crowd chasing 500% in a bull run, but sustained for 60 years, it turned a dying textile mill into a global empire. Buffett's genius is not finding ways to sprint, it's never being forced to stop. Jim Simons is another. The Medallion Fund has averaged more than 60% annually before fees for decades, the best sustained performance in history. But their edge isn't a reckless sprint, it's a tightly controlled, deeply quantitative system where risk management is an integral part of its alpha generation. The engine never stalls because the rules never change. A well-built algorithmic system is the purest form of the tortoise's discipline. A machine doesn't get greedy in a bull market. It doesn't panic in a crash. It never feels the urge to double down after a loss. It keeps capital in reserve. It waits for statistical extreme conditions where the risk reward is asymmetric because the market is overreacting. And when it does act, it acts according to plan. Every entry, every exit predefined. In crypto, this discipline isn't optional, it's survival. The hares make fortunes in euphoric markets and give them back in the inevitable washout. The tortoise survives every halving, every liquidation cascade, every flash crash, not through luck, but through design. At Minotaur Trading Systems, we've designed our algorithms to run the tortoise's race. We optimize not for the biggest return in the shortest time, but for the ability to still be here in decades from now. For compounding without interruption, for capital that survives every single storm. And when the next shock comes, and it will, the hares, they're gonna vanish again. The tortoises though, they'll still be here, still compounding, still moving forward, still winning the only race that matters, the one that never ends. So if you're ready to stop sprinting toward burnout and start running the only race you can actually win for life, book a call with us today. We'll walk you through exactly how our automated systems enforce this discipline, strip away the destructive impulses, and keep your capital compounding long after the hares have disappeared.